Hi, I'm James Robinson. I manage money for a living, and this is my stock pick of the week. This is the second in my 5-part series on the company Alphabet. Today we're going to talk about the company's operations. What I'm really looking at here is what kind of job does the company do in delivering goods and service to the customer? How efficiently do they do that? I'm also looking for signs that the company is a consumer monopoly, which Warren Buffett describes as a company with real pricing power, as opposed to a commodity company where when the commodities are doing great, your specific commodity is doing great, you make a lot of money, but when the commodity is doing poorly, you can't make money. And we're looking for consumer monopolies as investors. So that's really what we're trying to diagnose when we look at the operations of the company. To me, the first diagnostic tool to look at whether or not a company is a consumer monopoly is to look at the gross margins. You can't have pricing power if you have very narrow gross margins. So if you think about airlines or grocery stores, they're companies with commodities. There's no real difference between Delta Airlines, United Airlines, and American Airlines. And so everybody just buys on price. The same thing when you go to grocery stores, Safeway, Albertsons, they're all the same. So we're looking for companies that have pricing power. We're looking for companies that have higher gross margins. So just to give you a sense, a gross margin is when you take your revenues, you subtract out the cost of goods sold, you get operating income. That operating income as a percentage of revenues is your gross margin, and you want that number to be as high as possible. So when we look at the number for Alphabet, what we see here is gross margins consistently in the top 25% of companies, and we like to see that being very, very stable. What we want is a competitive advantage, and that's demonstrated by high gross margins. We also want that to be durable. That means it has to sort of move in the same range for a long period of time. And that's something that this company's been able to do really since before 2001. So gross margins for this company are very attractive. They're very high, top 25% of companies. Again, I like to see gross margins of at least 40%, and these guys' gross margins are 50% above that at around 60%. So really love the company for the gross margins. Obviously, one thing you like to see is earnings growth. That means you buy a stock today and it makes more money every year. Earnings growth is something that really does allow us to compound our returns as investors. And there are very few companies that have been able to do a better job on this than Google. If you look at these earnings per share, they're basically parabolic. They're just straight up. And obviously, this trend doesn't have to continue for very long before this is a very, very good company. Company's gone from virtually no earnings in 2004 to 75, I think it's $72 billion last year. That's spectacular. When you look at the earnings per share, they've gone up even faster. And again, that's as a result of the fact that they bought back some shares. So very, very solid company. The earnings are exploding. The fact that we're able to buy a company like this at 18 times earnings is the silver lining of the fact that we're in a recession, the silver lining of the fact that we're in a bear market. The good thing about bear markets is spectacular companies get underpriced, and we're able to buy them, and then we'll hold it hopefully for years and years as this company continues to do great, and we'll look like geniuses. So gross margins are a look at the company's operating income as a percentage of revenues. The first slide is net earnings as a percentage of revenue. So obviously we take out the cost of goods sold, but we've got other operating costs. So when we back all those out, we like to see how this company is doing. This company, the goal is they'd have gross margins of about 20%. This company's been in that range consistently, which also puts in the top, 25% of companies. So it does a great job of converting revenues and converting operating income to profits. That's something we look for. Again, what I'm really looking for is the consistency that's something that we can predict is likely to continue for a long time into the future. Because when we buy a stock, we're buying it not so much for the past, but for the future. But if a company's been able to stay in the same business and maintain very high net earnings as a percentage of revenue, that should show you that they, at least for the short term, should be able to continue that trend. And we just continue to look for that as we own the stock. The next slide just looks at revenues, which you see again are parabolic, and the earnings, which have also gone up dramatically. So this is a company that continues to expand its market share, continues to move into new businesses. We all know the stories that Google does a lot of neat things to generate new businesses, and how YouTube was created, and how Google Maps was created, and Gmail, and all of the different facets of their business. So long story short, again, what you're going to see over and over again with this company is things look really, really good here. So now we go on to what I call the four taxes. There's really a fifth tax, but the four taxes are things that every company has to spend money on, but not every company has to spend the same amount of money on. And what we're looking for here is red flags. We're looking for areas where the company spends a lot of money disproportionate to what it should. And then we try and figure out, is that something that's going to, in the long term, be a red flag for this business? So the first cost here is selling and general administrative. You can see this company is in the top 25% of companies. It's been in a very narrow band since 2001. It looks like it's going to continue to stay in that band. Actually, those costs have been going down for the last 2 or 3 years. So the selling and general administrative of this company seems like something that should be great and not really a problem. The next one is plants and equipment as a percentage of profits. And you can see since 2012, that number has been going up. So that's a concern. I don't like things that go up consistently. The last year or two, it's come down a little bit. One of the reasons why I think this is the equipment aspect. As this company has grown, they've needed to get more and more computers. Additionally, they've gone into cloud services, which is going to cause their plants and equipment to go up. And this is plants and equipment as a percentage of assets, not as a percentage of revenues. I just like to get a sense for what's going on with the plants and equipment. And so this is something that, again, it's not in the top 25% of companies. It's sort of very, very average, but it's very average and it's been going up consistently. So this is the kind of thing that would be a problem. It's not a huge problem because it's not a huge cost down for this company, but it's the kind of thing that as an investor, I would continue to keep an eye on because at some point it really could become a problem. So the third of the four taxes is inventories. Companies that have a lot of inventories have a lot of opportunity to lose money in the future. Inventory goes stale. In technology companies, for example, they make Pixel phones. If they have a ton of Pixel phones and nobody buys them, that just becomes garbage and you wasted all the money that it costs to produce those items. Plus, it's money that you have tied up in the balance sheet that's not productive. So we don't like companies with a lot of inventory. And you can see here for this company, there's virtually no inventory, so there's not much to talk about on that front. The next big tax is R&D as a percentage of gross profit. And so my concern with R&D is I don't really like technology companies because I don't know for sure if the technological advantage they have is sustainable. Obviously, Google has sort of place of mind, and you're not likely to switch from Google Mail to some other mail, and you're maybe not likely to switch so quickly from the Google search engine to some other search engine. But this company has to spend a lot of money to maintain that competitive advantage. And while they're spending all that money, that's money that can't be paid back to me, the shareholder. I'd prefer they didn't have to do that to maintain their competitive advantage. The other problem is that somebody else might come up with a better mousetrap, and then this company's in big trouble because they're really selling their technological advantage. So when I see high R&D, that really bothers me. And this company does have very, very high R&D costs. Again, it's sort of offset by the fact that the selling general administrative is low and the inventories are low. But I don't love companies with big, high R&D costs. And so this is again, one of the reasons why this company wouldn't be in my top 10 companies I've ever looked at. It's still very, very good. But again, every company has issues for concern. And for this company, that's the area of concern. The next tax that I worry about is interest expense. And that's obviously completely self-inflicted. A great company will have very little debt. And because they have very little debt, they have very little interest. And therefore, this tax is zero. This company has what relative to the size of the company is very little debt. The interest expense is irrelevant to the operations of the company, so there's not much to talk about here. But again, generally speaking, you'll find that interest payments can become a big problem because it's a payment you have to make. It's a payment you can't downsize out of. And as interest rates are going up now, we're going to see some of these companies that are very highly leveraged get into big trouble, which makes our decision to try and focus on companies with very little debt and to really pay attention to the interest payments as a percentage of operating costs, operating income. It's going to pay dividends because we're not going to get ourselves into trouble by buying companies that have all these real risk factors. So in summary, when looking at operations, we have a company with really high gross margins. They're in the top 25% of companies. They've been very, very stable. That's the absolute first thing that I look at, and I really like that about this company. Number two, obviously very important, the company has explosive growth in earnings, and the earnings per share are even higher than that because the company has bought back a little stock. So when you look at really high gross margins and you look at really strong earnings and earnings growth, that's pretty sexy. The earnings as a percentage of revenue are great, and you see the revenues growing spectacularly. Selling general administrative has been strong. It's not too high. It's consistently in the top 25% of companies. I think that's likely to continue. That shows me that management does a pretty good job of managing costs. I'm not as happy with, also the company has virtually no inventory cost to speak of. Both plants and equipment and R&D are higher than I would like, plus they're rising costs, so I don't love that. It's not the end of the world. Every company has some area of weakness. There's no perfect company. But I do think that you should, monitor it, or we should monitor it and keep it in mind. Make sure those costs don't get too out of hand. Taking in context, interest payments, interest expense for this company is a non-issue. They do pay a lot of interest, but not relative to their $72 billion of earnings. So, after looking at the operations of Alphabet, I think it's easier to justify buying it. You're buying at 18 times earnings, which is a very high number on the high end of what I would ever buy a company for. But this is a unique company, uniquely placed in the world, and we're getting a chance to buy it because it's on sale, and I think we should take advantage of that. So that's it for operations. Thank you very much for your time.